The foreign earned income exclusion and the foreign housing exclusion. What we're looking at here is the possibility that some foreign earned income or that foreign housing allowance can be excluded from U.S. taxes. Now, the general rule is that if you're a U.S. citizen or a resident alien in the United States, you need to pay taxes on all of your worldwide income. Whether you live in the United States, you don't live in the United States, you pay taxes on your worldwide income. But it's possible that a taxpayer can qualify to exclude some or all, depending on how much they earn, some or all of their foreign earnings from the income calculation. Now, for the tax year 2020, the foreign earned income exclusion cannot be more than the smaller of $107,600, okay, this is per individual, or the foreign earned income for the tax year minus the amount of foreign housing exclusion or housing deduction. So you can't exclude more than you actually made. Okay, so it's limited to $107,600, but if you didn't make that much, you can't exclude any more than you actually made. Now, for the foreign housing exclusion, we may be able to exclude or deduct certain foreign housing amounts limited to the smaller of the foreign housing costs paid for with employer-provided amounts, or the amount of foreign earned income. Again, we can't exclude more than it is that we earn. Now, for the purpose of determining the foreign housing exclusion or deduction, a taxpayer cannot consider housing expenses that exceed a certain limit. Now, generally, that limit is 30% of the maximum foreign earned income exclusion, but depending on location, it may change a little bit, but that's just kind of the general rule for that. Now, we have to qualify to be able to claim these exclusions, and there are 3 requirements that we need to be able to meet. So first, the tax home must be in a foreign country. Now, that tax home is the place where the taxpayer permanently or indefinitely engages to work as an employee or self-employed individual. The tax home is not in a foreign country for any period in which the taxpayer's abode is in the United States, and the abode is where the person lives. Okay, so the tax home must be a foreign country. The taxpayer must have foreign earned income, and the taxpayer must meet either the bona fide residence test or the physical presence test. Okay, the bona fide residence test or the physical presence test. Now, what we're proving here with these 2 tests is that you actually live abroad. Okay, that you live in that foreign country. So the bona fide residence test. Now, this is just people look at you and say, you live somewhere else. You don't live in the United States. We don't automatically acquire bona fide residence status merely by living in a foreign country for 1 year. The length of stay, the nature of the job are also taken into account to determine whether or not we are actually a bona fide resident in that foreign country. So if you travel to a foreign country to work on a particular job for a specific period of time, then you're probably not going to be a bona fide resident, even if it's more than 1 year, because everybody knows, and you know, that at the end of that specific time period, you're going to return. So it's just kind of an extended, long-term, long-distance job placement. Now, during this period of trying to claim bona fide residence, the taxpayer can leave that country for brief, temporary trips back to the U.S. or other countries for vacation or business. So again, what we're looking at here is people will just look at you, they'll talk to you, and they will say, wow, you live somewhere else. You live in a different country. Okay? Doesn't mean you never come back to the United States. You might have other family relatives here that you want to come visit for the holidays, whatever the case may be, but people will look at you and say, yes, that person lives abroad. Now, in order to be able to be a bona fide resident, we must be a U.S. citizen who's a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. Okay, so we need to have that whole calendar year. Or a U.S. resident alien, or as a citizen or national of a country with which the U.S. has an income tax treaty in effect, and who is a bona fide resident of a foreign country for that entire tax year. So we need to get that entire tax year in order to make all of this work. Now, a couple of examples here. You arrived with your family in Lisbon, Portugal on November 1st, 2019. Your assignment is indefinite, and you intend to live there with your family until your company sends you to a new post. You immediately established residence there. You spent April of 2020 at a business conference in the United States. Your family stayed in Lisbon. Immediately following the conference, you returned to Lisbon and continued living there. So, on January 1st, 2021, you completed an uninterrupted period of residence for a full tax year, 2020, and you meet the bona fide residence test. That little trip back to the U.S. doesn't matter. Your family stayed there. You went back. People will look at you and say, yep, you live in Lisbon. Okay, your family's there. That's where you are. That's where you work. You live in Lisbon. Now, let's take those same facts, except that you transferred back to the United States on December 13th, 2020. You don't meet the bona fide residence test because it didn't include a full tax year. It was more than a year, but it wasn't a full tax year. And so you needed to talk to your employer and ask for a few more weeks before you get sent back. So you would meet those requirements. Now, even though you're not a bona fide resident, you might qualify under the physical presence test. Okay, there's one of two that you have to meet, and the bona fide is people look at you and say, yeah, that person lives abroad. Well, our second test is the physical presence test, and so a U.S. citizen or U.S. resident alien physically present in a foreign country for at least 330 full days during any period of 12 consecutive months. Okay, just physical presence. The name describes it. How long you are there. Doesn't depend on what your intentions are, doesn't count on how long you think you're going to be there, whether there's a specified time period. It's just in this year you were out for 330 days. So, example, you're a construction worker who works on and off in a foreign country over a 20-month period. You might pick up the 330 full days in a 12-month period only during the middle months of the time you work, because the first few and last few months of that 20-month period are broken up by long visits to the U.S. So we're looking for that time period where we have it. Now, another example, you work in New Zealand for a 20-month period from January 1st, 2019 through August 31st, 2020, except that you spend 28 days in February 2019 and 28 days in February 2020 on vacation in the U.S. So you are present in New Zealand for at least 330 full days during each of two 12-month periods, January 1st to December 31st, 2019, and also September 1st, 2019 to August 31st, 2020. And so by overlapping those 12-month periods that we're trying to get those 330 days in, we can meet the physical presence test for that whole 20-month period that we were out of the country and that we were working. And so we're trying to get 330 days in 12 consecutive months to be able to exclude that income up to that amount. So we have our income exclusion, we have that foreign housing exclusion, but we have to be able to demonstrate that we qualify for it. And we've got the two requirements, the bona fide resident requirement and also that physical presence. And just a matter of if you've got this overseas income, you're supposed to, U.S. pay taxes worldwide, but you may be able to exclude some or all of that foreign earned income if you're able to demonstrate that you qualify for the foreign income exclusion.